Good morning, everyone. I'm Eric from Market Meridian, and welcome to a special, extended edition of Market Deep Dive. Today is April 14th, 2026, and if you haven't checked your financial news in the last 12 hours, you're about to hear why the global financial community is on high alert. This isn't a routine Fed update, a monthly jobs report, or a corporate earnings miss. It's a single document that has sent shockwaves through Wall Street, Main Street, and financial capitals around the world, the annual shareholder letter from Jamie Dimon, Chairman and CEO of JPMorgan Chase and Co. Call Jamie Dimon a power player on Wall Street is an understatement. He is often hailed as the king of Wall Street, and for good reason. He has led JPMorgan for over 2 decades, outlasting nearly every other CEO in the banking sector. He steered the bank through the 2008 great financial crisis, when many of his competitors collapsed or required government bailouts. He navigated the 2020 COVID-19 pandemic, a time of unprecedented market volatility and economic shutdowns. Through it all, JPMorgan has emerged stronger, solidifying its position as the world's most powerful bank with a balance sheet so robust it's often called a fortress. When Jamie Dimon speaks, the markets don't just listen, they react. His past warnings have been prescient. He sounded the alarm on subprime mortgages before 2008, warned about the risks of excessive government spending during the pandemic, and cautioned against complacency in the face of rising inflation in 2022. But his latest warning, in this year's shareholder letter, is his most dire yet. Dimon is not just pointing to isolated risks, he is warning of a convergence of unprecedented, interconnected threats that he believes could trigger a systemic crisis in the U.S. economy, a crisis that could ripple across the globe. In his letter, Dimon outlines what he calls a triple threat facing the U.S. and the global economy: persistent, sticky inflation that refuses to be tamed, a massive, unsustainable fiscal deficit that is spiraling out of control, and a geopolitical landscape that is fragmenting at an alarming rate, reshaping the global order as we know it. But that's not all. He also highlights 2 more critical pillars of risk: the hidden dangers in the shadow banking system and the myth of the soft landing that the market has been clinging to for the past 18 months. Today, we are going to take a deep dive into each of these 5 pillars. We'll dissect Dimon's core arguments, back them up with the latest economic data, and analyze what they mean for you, whether you're a seasoned investor, a small business owner, or a regular American trying to navigate the current economic landscape. We'll ask the tough questions. Why is the man who has survived and thrived through some of the worst economic crises in modern history now sounding the alarm so loudly? Is this a calculated move to manage market expectations, so JPMorgan can outperform when the inevitable downturn hits? Or are we truly standing on the precipice of a hard landing, one that could rival the 2008 crisis in severity? Before we dive in, let's set the stage. What you're seeing is the world of finance that Jamie Dimon inhabits, a world where every decision, every warning, carries weight. He is not a permabear, he is a realist. And right now, his realism is painting a grim picture. Let's start with the first pillar of his warning, the myth of the soft landing. Pillar 1, the myth of the soft landing. For the past 18 months, the mainstream narrative in financial circles has been the soft landing. You've heard it on every financial news network, read it in every market analysis report, and heard it from Federal Reserve officials. The Fed can raise interest rates to cool inflation, bring prices back to its 2% target, and avoid a recession. It's the Goldilocks scenario, everything just right, not too hot, not too cold, but Jamie Dimon is calling bull on that consensus. In his shareholder letter, he pulls no punches. The odds of a soft landing are much lower than the market is currently pricing in. The market is suffering from a sugar high, fueled by past government stimulus and a false sense of security that inflation is under control. That security is an illusion. Dimon's core argument centers on the stickier nature of inflation. Let's break that down. Since March 2022, the Federal Reserve has raised interest rates from near zero to their current level of around 5.25% to 5.50%, the most aggressive hiking cycle in decades. And while headline inflation has come down from its peak of 9.1% in June 2022, it remains well above the Fed's 2% target, hovering around 3.5% as of March 2026. But Dimon warns that this progress is deceptive. He points to three underlying drivers of inflation that are inherently inflationary and show no signs of abating: wage growth, housing shortages, and the global green energy transition. Wage growth in the US has been running at around 4.5% to 5% annually, well above the level that is consistent with the Fed's 2% inflation target. This is a classic case of the wage price spiral. As workers demand higher wages to keep up with rising prices, companies pass those higher labor costs on to consumers, pushing prices even higher. Then there's the housing shortage. The US has been grappling with a severe shortage of affordable housing for years, with an estimated deficit of 1.5 million to 2 million homes. This shortage has kept housing prices elevated, even as mortgage rates have risen. Rent prices, which are a key component of the Consumer Price Index, CPI, have also stayed high, putting persistent pressure on inflation. Dimon notes that until the housing supply issue is addressed, inflation will remain sticky. Finally, the green energy transition. While transitioning to renewable energy is essential for long-term environmental sustainability, it is also incredibly expensive in the short term. Governments around the world are pouring trillions of dollars into renewable energy projects, electric vehicles, and infrastructure upgrades. These investments are driving up demand for raw materials, lithium, copper, nickel, and rare earth metals, pushing their prices higher. At the same time, the phase-out of fossil fuels is leading to higher energy prices, as supply struggles to keep up with demand. Putting this all together, Dimon issues a stark warning: interest rates might not just stay higher for longer, they could actually swing back up toward 8%. That's a number that should send chills down the spine of every American. Let's do the math. If the Fed is forced to raise rates to 8%, the impact would be catastrophic for the average household and the broader economy. Mortgage rates, which are already around 7.5% as of April 2026, would skyrocket to double digits, potentially 10% or higher. For a family looking to buy a $400,000 home, a 10% mortgage rate would mean a monthly payment of over $3,500, up from around $2,700 today. That's an increase of nearly $10,000 per year, money that most families simply don't have. This would crush the housing market, leading to a sharp drop in home prices and a wave of foreclosures, similar to what we saw in 2008. Corporate refinancing would become a nightmare. Since the 2008 crisis, many companies, especially so-called zombie companies that are barely profitable and survive only on cheap debt, have taken on massive amounts of debt at low interest rates. If rates hit 8%, these companies would struggle to refinance their debt, leading to a wave of corporate bankruptcies. We're already seeing early signs of this. In 2024, U.S. corporate bankruptcies hit a 14-year high, with 686 companies filing for bankruptcy, a figure that is likely to rise as rates stay elevated. Companies like Party City, Tupperware, and Red Lobster have already fallen victim to high rates and weak consumer demand, and Dimon warns that this is just the tip of the iceberg. Dimon's message is clear: the Goldilocks scenario is a fantasy. We are not going to avoid pain. Instead, we need to prepare for what he calls a salami-style recession, thin slices of pain across different sectors of the economy, one after another, until the entire economy feels the chill. First, it will be the housing market, then the corporate sector, then consumer spending, and eventually, the broader economy. The question is not if this will happen, but when, and how severe it will be. Pillar 2, the fiscal time bomb. If the myth of the soft landing is the first pillar of Dimon's warning, the U.S. fiscal deficit is the second, and perhaps the most dangerous. In his letter, Dimon gets granular. diving into the numbers and warning that the US government is addicted to spending and that we are rapidly approaching a tipping point that could undermine the dollar's status as the global reserve currency. Let's start with the facts. As of April 2026, the US federal government is running a fiscal deficit of roughly 6% of GDP. To put that in perspective, traditionally, deficits of this magnitude are only seen during major wars or deep recessions, think World War II, the 2008 financial crisis, or the 2020 pandemic. But right now, we are seeing this deficit during a period of supposed economic growth. The International Monetary Fund, IMF, projects that the US deficit will hit 6.1% of GDP in 2026 and rise to 6.3% by 2028. The US Congressional Budget Office, CBO, is even more pessimistic, forecasting a deficit of 5.8% of GDP in 2026, rising to 6.7% by 2036. The numbers get even more alarming when you look at the national debt. As of March 2026, the US national debt has surpassed $39 trillion, a figure that has increased by $1 trillion in just 5 months, and $2 trillion in less than a year. To put that in context, the US debt is now larger than the country's entire GDP, with the CBO projecting that public debt as a percentage of GDP will rise from 101% in 2026 to 120% by 2036. Surpassing the historical high of 106% set in 1946 after World War II. But the real problem isn't just the size of the debt, it's the cost of servicing it. In 2025, the US government spent $1.2 trillion just on interest payments on its debt, more than the $900 billion it spent on national defense that year. As interest rates rise, this cost will only grow. Dimon warns that if rates hit 8%, interest payments on the national debt could reach $2 trillion per year by 2030, absorbing nearly a third of all federal tax revenue. That's money that could be spent on education, infrastructure, healthcare, or reducing the deficit, but instead, it's going to pay interest on past spending. So, how did we get here? Dimon points to the government's open spigot of spending. Over the past decade, the US government has passed a series of massive spending bills, the Inflation Reduction Act, the Infrastructure Investment and Jobs Act, multiple military aid packages for Ukraine and other allies, and pandemic-era stimulus programs. While some of this spending was necessary, especially during the pandemic, Dimon argues that the government has failed to exercise fiscal discipline, continuing to spend far more than it collects in tax revenue. This excessive spending has created a massive supply of US Treasury bonds. The government issues these bonds to finance its deficit, and when it issues more bonds than the market wants to buy, bond prices fall and yields rise. This creates a vicious cycle. Higher yields mean the government has to spend more on interest payments, which increases the deficit further, requiring more bond issuance, which pushes yields even higher. Dimon's biggest concern here is the tipping point where the world loses its appetite for US Treasuries as a risk-free asset. For decades, US Treasuries have been considered the safest investment in the world, backed by the full faith and credit of the US government. This has allowed the US to borrow trillions of dollars at low interest rates, and it has cemented the dollar's status as the global reserve currency, meaning most international trade is conducted in dollars, and central banks around the world hold dollars as their primary reserve asset. But if the US continues to run massive deficits and the national debt keeps spiraling, foreign investors, especially China and Japan, which hold trillions of dollars in US Treasuries, may start to lose confidence. They may demand higher yields to compensate for the increased risk, or they may start selling their treasuries altogether. If that happens, the dollar's status as the global reserve currency could be at risk. And if the dollar loses its reserve status, the consequences for the US economy would be catastrophic: higher inflation, higher interest rates, a sharp drop in the value of the dollar, and a loss of global economic influence. The CBO has warned that the US fiscal path is unsustainable, and Dimon echoes that warning. He writes, "We cannot keep spending money we don't have. The fiscal time bomb is ticking, and if we don't defuse it soon, it will explode, with consequences that will be felt by every American. Pillar 3, Geopolitical Fragmentation and the New Cold War. Perhaps the most somber part of Dimon's analysis is his assessment of the global geopolitical landscape. He calls this the most dangerous time for global stability since World War II, and warns that the era of globalization and its peace dividend that came with it is over. For decades, globalization allowed for cheap goods, low inflation, and a more interconnected global economy. Companies moved manufacturing to low-cost countries, supply chains stretched across continents, and international trade flourished. This era brought unprecedented economic growth and lifted hundreds of millions of people out of poverty. But Dimon argues that this era is dead, killed by rising geopolitical tensions, protectionism, and a shift toward deglobalization. The primary driver of this fragmentation is the rise of geopolitical rivalry, most notably, the growing tension between the US and China. What was once a mutually beneficial economic relationship has devolved into a Cold War-style rivalry, with both countries competing for dominance in technology, military power, and global influence. The US has imposed tariffs on Chinese goods, restricted Chinese access to advanced technology, like semiconductors, and strengthened its alliances in the Indo-Pacific region. China, in turn, has sought to expand its influence through initiatives like the Belt and Road, and has increased its military presence in the region, but the US-China rivalry is just one piece of the puzzle. Dimon specifically mentions three major geopolitical flashpoints that are disrupting the global economy: the ongoing conflict in Ukraine, the tensions in the Middle East, including the recent escalation of the Iran war, and the growing tensions in the Taiwan Strait. Each of these conflicts is not just a humanitarian tragedy, they are economic disruptors that threaten energy security, global trade routes, and supply chains. The war in Ukraine, which has now dragged on for more than 4 years, has disrupted global energy markets, pushing up oil and gas prices. It has also disrupted supply chains for key commodities like wheat, corn, and fertilizer, leading to higher food prices around the world. The recent escalation of tensions in the Middle East, particularly the Iran war, has further threatened energy security, with the potential for attacks on oil tankers in the Strait of Hormuz, a critical choke point for global oil supplies. A disruption to oil flows through the Strait of Hormuz could send oil prices soaring to $150 per barrel or higher, further fueling inflation. Then there's the Taiwan Strait. Taiwan is a critical hub for the global semiconductor industry, producing more than 60% of the world's semiconductors and 90% of the most advanced chips. Any conflict over Taiwan could disrupt the global supply of semiconductors, which are essential for everything from smartphones and computers to cars and military equipment. This would cripple industries around the world and lead to widespread economic disruption. Dimon also highlights the trend of reshoring and friendshoring of supply chains. In response to geopolitical tensions and supply chain disruptions during the pandemic, many companies are moving manufacturing back to the U.S. or to allied nations, friendshoring. While this is essential for national security and supply chain resilience, it is also incredibly expensive. Building new factories, hiring workers, and establishing new supply chains costs billions of dollars, and those costs are ultimately passed on to consumers, pushing inflation higher. The World Economic Forum's 2026 Global Risk Report echoes Dimon's concerns, noting that geopolitical tensions are now the top short-term risk facing the global economy, with 18% of experts citing it as the primary crisis driver. The report also warns that multilateralism is declining, protectionism is rising, and trade and technology are increasingly being used as strategic weapons. Dimon's warning here is systemic: you cannot have a stable global economy if the geopolitical floor is cracking. He urges CEOs and policymakers to stop focusing on short-term quarterly earnings and start thinking about long-term national resilience. We need to invest in our infrastructure, our workforce, and our alliances, he writes. We need to recognize that geopolitical risk is economic risk, and if we ignore it, we will pay a heavy price. Pillar 4, the hidden risks in shadow banking. Now, let's turn to a topic that rarely makes the evening news but could be the spark that ignites the next financial crisis: shadow banking. As the leader of a regulated commercial bank, Dimon has long complained about the uneven playing field between traditional banks and shadow banks. But his warning today is not about competition. It's about systemic risk. First, let's define what shadow banking is. Shadow banking refers to financial institutions that provide banking-like services, such as lending, borrowing, and asset management, but are not regulated like traditional banks. This includes private equity firms, private credit funds, hedge funds, fintech lenders, and other non-bank financial institutions. These entities play a critical role in the global financial system, providing credit to companies and individuals that may not have access to traditional bank loans. Since the 2008 financial crisis, regulation has forced traditional banks like JPMorgan to hold massive amounts of capital to prevent another collapse. This has made traditional banks safer, but it has also pushed a significant amount of risky lending into the shadow banking system. Why? Because shadow banks are not subject to the same strict regulations as traditional banks. They don't have to hold as much capital, they don't have to disclose as much information about their investments, and they aren't covered by deposit insurance. The size of the shadow banking system is staggering. According to the Financial Stability Board, the global shadow banking sector has grown to more than $200 trillion, larger than the global traditional banking sector. In the US, private credit funds alone now manage more than $2 trillion in assets, a figure that has doubled in the past decade. These funds have become major lenders to mid-sized companies, many of which are too risky for traditional banks to lend to. Dimon's biggest concern is the lack of transparency in the shadow banking system. Unlike traditional banks, which are required to disclose detailed information about their loans and investments, shadow banks operate in the shadows. We don't know exactly what assets they hold, how much leverage they're using, or who their counterparties are. This lack of transparency means that if a major private credit fund or hedge fund collapses, say, because of rising interest rates or a default by a major borrower, we don't know who is holding the bag. Dimon warns of a potential liquidity crunch in the shadow banking system. In a crisis, investors and counterparties will try to sell their assets at the same time to avoid losses. But if shadow banks don't have enough cash on hand to meet these demands, known as a liquidity shortage, the market could freeze. We saw a glimpse of this in 2022 with the UK gilt crisis, when a sudden rise in interest rates led to a liquidity crunch in the UK's pension system, forcing the Bank of England to intervene. We also saw it in 2023 with the collapse of Silicon Valley Bank, which was partially caused by a run on deposits and a lack of liquidity. But Dimon says the next crisis in the shadow banking system will be much bigger and much harder to see coming. He notes that private credit funds often lack transparency, and their loan valuations are not as strict as those of traditional banks. This means that even if actual losses are relatively small, the perception of risk could lead to a wave of redemptions, forcing funds to sell assets at fire sale prices. This could trigger a chain reaction, as falling asset prices lead to more redemptions, more selling, and ultimately, a systemic crisis. Recent events have already highlighted these risks. In late 2025 and early 2026, several major private credit funds faced massive redemption requests, particularly those with exposure to software companies and other high-risk borrowers. Some funds have been forced to restrict redemptions or suspend, echoing the liquidity crises we saw in 2008. Dimon warns that these are not isolated incidents, they are signs of a broader problem in the shadow banking system. The shadow banking system is like a ticking time bomb, Dimon writes. We don't know when it will explode, but we know it will. The lack of transparency and regulation means that the next financial crisis could start in the shadows, and by the time we see it, it will be too late. Conclusion: how to position your portfolio. So, what is the bottom line? Is Jamie Dimon just a permabear trying to lower market expectations so JPMorgan can outperform when the inevitable downturn hits? Or is he truly warning us of an impending economic storm? The answer, according to Dimon's actions, is clear. He's not just talking, he's preparing. JPMorgan currently has a fortress balance sheet, with more than $1.5 trillion in cash and high-quality liquid assets. The bank is sitting on a mountain of cash, positioning itself to be the buyer of last resort when the market crashes. When other banks and financial institutions are forced to sell assets at fire sale prices, JPMorgan will be there to buy them up at a discount, just like it did during the 2008 crisis. But what does this mean for you? Whether you're a seasoned investor or a beginner, Dimon's warning has clear implications for how you should position your portfolio. Let's break down the key takeaways first. Liquidity is king. In an environment where interest rates could hit 8% and a liquidity crunch could occur, cash is not trash, it's an internal hedge. Having a portion of your portfolio in cash or cash equivalents, like treasury bills, will allow you to weather market volatility and take advantage of opportunities when assets are cheap. Dimon advises investors to hold more cash than you think you need to avoid being forced to sell assets at a loss during a crisis. Second, watch the yield curve. The bond market is often a leading indicator of economic trouble, and the yield curve is one of the most reliable signals. An inverted yield curve, where short-term interest rates are higher than long-term rates, has preceded every recession since the 1950s. Right now, the yield curve is inverted, and Dimon warns that this is a clear sign that the market is pricing in a recession. Pay attention to the bond market, it will tell you the truth long before the stock market does. Third, diversify geopolitically. Don't bet everything on a single region or a single supply chain. The geopolitical landscape is fragmenting, and risks are rising around the world. Dimon advises investors to diversify their portfolios across different regions, currencies, and asset classes. This means investing in international stocks, bonds, and commodities, as well as assets that are resilient to geopolitical shocks, like gold, real estate, and infrastructure. Fourth, avoid excessive leverage. In a high-interest rate environment, debt becomes expensive. Whether you're a business owner or an individual, avoid taking on too much debt. For investors, this means avoiding margin trading and other leveraged investments that could amplify losses during a market downturn. Dimon warns that leverage is a double-edged sword. It can boost returns in good times, but it can destroy you in bad times. Finally, stay disciplined. It's easy to get caught up in market hype or panic, but successful investing requires discipline. Stick to your long-term investment plan, avoid making emotional decisions, and don't try to time the market. Dimon notes that the best investors are those who stay calm when everyone else is panicking, and stay patient when everyone else is greedy. It's important to note that Dimon is not all doom and gloom. He ends his shareholder letter with a note of American exceptionalism, saying that the US has the secret sauce to overcome these challenges: innovation, resilience, and a strong entrepreneurial spirit. But he makes it clear that this sauce only works if we stop ignoring the fire in the kitchen. We need to address the fiscal deficit, tackle inflation, strengthen our supply chains, and navigate the geopolitical landscape with caution. As we wrap up today's deep dive, it's important to remember that warnings like Dimon's are not meant to scare you, they're meant to prepare you. The economic storm he's warning about may not hit tomorrow, next month, or even next year. But it will hit. And those who are prepared will be the ones who survive, and even thrive, when it does. We will continue to track the market's reaction to Dimon's warning in the days and weeks ahead. We'll bring you updates on inflation, interest rates, the national debt, and geopolitical tensions. For now, I'm Eric, and this has been your Market Deep Dive. Stay safe, stay informed, and stay disciplined. Thank you for watching, and please subscribe my channel.